Hi, everybody. This is Big Ringer of Big Wealth Management. So glad you're here today. Today, I'm going to be talking about how to think about retirement. 10,000 people are trying to retire every day for the next 10 years, and there is only one defining financial issue in these individuals' lives. It's an issue which is perfectly straightforward. This issue is not the relationship between the Chinese currency and the US dollar. It isn't the unemployment rate, it isn't interest rates, it isn't the number of homes that are built or not built, or whether or not China is going to take over the world or Europe's going to default or what California is going to do. It isn't the federal deficit or national debt. The issue is nearly for every 65-year-old and the potential for a 20 to 30-year retirement. These issues simply won't matter, and they will in all probability not even be remembered. Side note, can you remember the emergency of the day 10 or 15 years ago? Didn't think so. The only issue in the financial lives of today's 10,000 or so 65-year-olds that'll be retiring over the next 10 to 20 years is, are they going to outlive their money, or is their money going to outlive them? Everything else is just noise. You see, it's a choice that we ourselves make, and the problem often is that we do not see ourselves making this choice, but we make this choice totally on a subconscious level. Let's discuss this for a minute. This is how we need to frame it. What would cause us to have our money outlive us? Simple. It would be if our income exceeded our cost of living. And of course, the reverse of that, what would be the most likely cause for us to outlive our money? That one is also very straightforward. That would probably happen if our cost of living at some point began to exceed our income, so that we had to draw down an ever diminishing pool of capital in order to sustain our lifestyle. The key to understanding the nature of this problem is to realize that our income needs are always a moving target. Now, according to Yahoo Finance, from 1926 to 2022, long-term inflation is about 3% a year. So that's something that will cost a dollar today will cost roughly $2.50 in the 30th year of retirement. Now, unless we have a strategy for creating an income stream that has some historical record of matching the upward curve of our living costs, our expenses may at some point begin growing at a rate faster than our income. And that's the formula for eventually running out of money. So it's all about preservation of purchasing power. So of course, we always want to look for investment classes and ideas that have historically managed to increase their income at a rate equal to or greater than the increase in the cost of living. Then we would apply that logical test to a list of available investments that have historically grown their income and grown at a rate faster than the cost of living. Now, we would then find that, according to Yahoo Finance, owning shares in a very broadly diversified portfolio of companies, that is their equities, stocks, has a far better long-term record of increasing income and thereby defending purchasing power than owning their bonds. According to Yahoo Finance, since 1935, as the cost of living has basically grown about 3% a year, the dividend of the S&P index has basically grown at about 5.5%. Now remember, the key of what I just mentioned is, what are the logical instruments? What are the logical vehicles to invest in given this situation? But the 10,000 or so people a year who are turning 65 for the next 10 to 20 years often have a very difficult time being logical because of their emotions. They look at their money as their lifetime savings, and they make very emotional decisions. A lot of it has to do with their environment growing up. They had parents or grandparents who grew up during the Depression. They were told that volatility is a bad thing and that the stock market is something to be feared. Now, this subconscious fear has stuck with them, and then they pass it on to their kids, and this fear comes out when the market temporarily goes down. The problem is that these individuals simply cannot imagine that they're going to be living a lot longer, possibly for a 30-year retirement, and have to cope with rising living costs for that long. In short, the 10,000 or so people turning 65 today who were brought up and taught to only be thinking about protecting their principal, when the true enemy in modern retirement is erosion of purchasing power. It's resulted in many of them having this way of thinking, and that may have caused them to over-concentrate their retirement savings in fixed income investments, bonds, as they experience a life of rising living costs and future goals they had not thought about that require the historical returns of the great businesses of the world and their stocks. If you're one of these folks that are retiring over the next 10 to 20 years, or maybe even sooner, you need to make sure and have this conversation with your wealth advisor sooner, not later. Don't ask them to predict the economy, what it will do next, which way the markets will go. Remember, your advisor does not know these things. Note a very famous saying: market prognostication exists to make astrology look respectable. Remember that no one knows how the market will move in the short term, and in a 3-decade retirement, today's concerns will not matter very much. The main question you need to ask yourself is: our money more likely to outlive us, or are we more likely to outlive our money? Now, here's a disclaimer. Economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. The S&P 500 index is a capitalization-weighted index of 500 stocks designed to measure performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. Bonds are subject to credit, market, and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price. Stock investing includes risks, including fluctuating prices and loss of principal. No strategy assures success or protects against loss. Thank you for your time.